Kia ora, welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name is Leighton Roberts and I'm a co-founder and co-CEO at Sharesies. Today, we're joined by Pi Fund's Head of Global Research, Guy Thornewill, and Mike Taylor, Pi's founder and Chief Investment Officer, to talk about chipmaker and tech phenomenon NVIDIA, which reported earnings above market expectations, and will also take a broader look at AI and its trajectory. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Well, welcome, Guy and Mike. Thanks so much for joining us. Let's start right from the top with NVIDIA's business model, that is how they make money, and the key business units in terms of revenue, which are the areas that hold the most value within the business, and also which bits are seen as having the greatest potential. NVIDIA, of course, is known for its GPUs, or graphics processing units. What's the technology actually used for?
Hi, Leighton. Thanks for having us on. Appreciate that. So NVIDIA's business model revolves around the development of GPU semiconductor chips and also related software architectures such as CUDA, which is kind of like their operating system, if you like. The company operates a fabless model, which means that they actually outsource all their production to companies like TSMC. They don't have their own semiconductor plants. They don't make anything themselves. So where are these chips used? They're used in a lot of different applications, anything from gaming to artificial intelligence, also in the auto market. But there are really two key areas which I'll touch on to explain the business model. That is the gaming side and the data center side. So on the gaming side, this has really been a cornerstone of NVIDIA's success over the years. They had their famous GeForce series, which gamers amongst the audience might have heard of. And that's a high-performance graphics chip, which is tailored for gaming enthusiasts. In 2015, the gaming unit accounted for about 60% of the total revenues. But by 2019, pre-COVID, it was still around 50%. But in the last few years, it's really reduced a lot. That's not because gaming has gone out of fashion, of course. In fact, their sales did really well during COVID, but it's because the huge growth in the data center unit. So gaming actually sales have grown by about 5 times in the last 10 years, and NVIDIA still has an 80% market share in this area. But the other main unit, and which really we'll probably talk about mostly today, is their data center unit. So that's the fastest growing business within the company right now. So their GPU architecture actually provides parallel processing capabilities, and that's really well suited for high-performance computing, accelerated computing, and that plays a really important role in the current development of AI and machine learning, which really needs high computing power, and that often takes place in data centers. So the data center unit initially contributed around 5% of total revenue going back 10 years, but that was actually 80% of the group's revenue last year. So it made a huge leap last year following the release of OpenAI's ChatGPT application and then the subsequent boom in AI.
I mean, those are mad numbers, astronomical changes in businesses. I was doing some Googling before this, and over the last 15 years, there's been like almost an article a year of some shock about NVIDIA and incredible facts you don't know in their growth, and they all basically pale in comparison to what's happened over the last 12 months, which is why I want to talk about the earnings at the moment. So the headline numbers, they came in above most analysts' expectations, and certainly the Sharesies platform was very busy with NVIDIA stock leading up to that, straight into after hours following that result, and then that flowed into the next day and following days. But what's your view on those earnings and how that sets the company up or changes the company for the future?
Yeah, you're right. It's been an incredible journey over the last year or so. So they did report a great set of results last week. They grew the sales 265% from the year before for the last quarter to $22 billion. That was about 8% ahead of what the market was expecting. And earnings actually grew 765%, so even faster. So why was that? That's because the margins went up a lot. So gross margins went up nearly 13 percentage points to 76%. which is really an incredible progression for such a large company. And that's because of the data center sales that I mentioned before. Those are really high margin sales, and that grew 400% to like $18.4 billion, I think it was. And if you compare that to a year ago, data center revenues were only $5 billion a quarter, so it's quadrupled in a year. Even so, the gaming revenues, which I mentioned as another important unit, they were still pretty good. It was $3 billion in the quarter, still up 50%. So that's not too bad, but just totally eclipsed by the really strong growth in data center. And the revenue guide they gave for the current quarter was also about 10% above expectations. So it really was a great result. It exceeded probably all but the most aggressive assumptions out there. The shares were up 16% on the day, which added an amazing $230 billion of market value just on the day they reported.
What are you seeing behind these numbers? Were there any surprises in there, any headwinds that you can see that might be hitting their way?
Yeah, not too many headwinds at the moment. I mean, we think there might be some that come down the road, but for now, not really. It was all pretty impressive. I mentioned just a few key things. Firstly, the pricing power the company has. We saw that in the gross margins I just mentioned. And in fact, we've heard that their H100 chips, those are the chips that get used mainly in data centers, and the customers for those are the cloud service providers or the CSPs, for example, Microsoft Azure, Amazon's AWS. So those chips have been changing hands on the black market for up to $70,000, we've heard, which is more than double the normal price. And that's just because demand is far outstripping supply right now. So TSMC just can't supply enough of the chips to NVIDIA, given the demand. So that's one point, pricing power. Secondly, those sales to the CSPs I mentioned, they're about 50% of data center sales in the quarter. That highlights there is some sensitivity to the spending patterns of the big tech companies like Microsoft and Amazon, Meta and Google. But that share is reducing a bit as other companies also start buying NVIDIA chips. And then the third point, I think this is actually the most important, and forgive me if it gets slightly technical, but I think this is important to understand. So NVIDIA disclosed last quarter that inferencing was about 40% of data center sales in the quarter. So just let me explain briefly what that means. So NVIDIA chips in data centers are mostly used for AI, as I've explained. Over the last year or so, these chips have been used for training large language models to understand and generate text. That's like the ChatGPT application that many people are using. So that needs huge computing power, a lot of GPUs, usually the H100 chip from NVIDIA. Now, once that training has been done, the next stage is actually to move to more specialized models for specific applications. So, for example, a company might use AI to help engage more effectively with its specific client base and to use its data more effectively. And that's done using a process called inferencing. That's essentially running live data through a trained AI model. That requires less computing power, and NVIDIA has other chips for this, such as something called the L40, which is a lot cheaper than the main data center chip, the H100. So a few analysts were actually surprised that inferencing was already 40% of data center sales last quarter. So what that implies is that demand for inferencing chips is really high right now. And that's actually the next stage of AI. So using specific applications rather than just doing all the training. And it means that stage is already taking off right now. Now, whether that generates as much revenue down the road as the H100 chips do today, well, that remains to be seen, but I think it shows that things are moving really quickly.
Yeah, the pace is mad. We've got we're using AI in a few tools at Sharesies now, and a few more in development at the moment. And the technologists in the business haven't seen a technology move this fast into value for companies. So that's the really surprising thing. I mean, people may or may not be surprised to know that since we released our AI customer query tool, it's called FinAI, it now does 60% of the customer responses, which, as you can imagine, is a material. We're a mass market business, right? We have thousands and thousands of messages a day, and that can materially change your cost base and where you can, the types of value that your support teams can offer. So really changes that dynamic for them. So, you know, and there's lots of cases like that in technology for the people, our engineers writing code, all that sort of stuff. Like, it's already been used and already seen value. And I know that AI has been a long journey, but really it sort of landed on us quite quick, I think, as something to be adopted so quickly. And I guess I'm just saying that because not always in these sort of hypes or bubbles or booms and stuff, you can see where the underlying value is. Personally, I have always struggled with that in the crypto space a little bit. Which for a long time in fintech was like the big word that got you funding, but now AI is the place to go, and the value is clearly there. Anyway, thanks heaps, Guy. I forgot to touch on earlier, Guy's actually tuning in from London as well, so really appreciate you joining us on the podcast today, Guy, and we'll be back to you in a second. But Mike, thought I'd just move over to you quickly. So I just want to speak a little bit about the background and the founders, etc. The idea for NVIDIA was kicked around at Denny's in 1993, apparently. Like, that's a long time ago, and like, sounds like a great tech story. Maybe you could give us a bit more background on how this whole company came about.
Yeah, I mean, there's a big gap there between Denny's in 1993 and 22 billion of revenue a quarter. But for those who are listeners who started their own business, and Leighton, you and I will know that when you start a business, there's often a few wobbles right at the beginning, and that was the case for NVIDIA. Bit of a background on the kind of the character. So Jensen is the CEO. There were two other founders no longer involved in the business, but they're about 30. They've been working for other tech companies in Silicon Valley, and they sort of got together. There's this Denny's cafe. Apparently it had a sort of bullet holes on the outside. It was quite a sort of down and out area of San Jose in California. And so they decided effectively that they wanted their gaming experience to be better, and that they want to, have been a basic graphics card to improve the gaming experience. And so that's what they set about. But their first chip wasn't that successful. As you can imagine, some of the other bigger competitors would have had, much more sales power into the gaming companies. And so they'd raised about 10 million, and it was a bit of a flop. And so they had to lay off half their staff, and things got pretty tight around about 1995, 1996. It was their third chip, the Riva 128, which was released in 1997. That was a bit of a breakout success and a game changer for NVIDIA. And shortly thereafter, it was picked up, of course, by the likes of PlayStation. And there's this quite famous story that in the PlayStation 3, in fact, that the US Army wanted to build a supercomputer, and so they needed all these chips quite quickly. So they grabbed, I think, 1,700 PlayStations, stuck them in a container, and that's how they got the supercomputer built very quickly. Business has been quite cyclical, though, I'd point out, as sort of different waves of tech spending. Is, perhaps Guy and I can talk about this a little bit later on in the podcast, but it is a cyclical business. It's not like software as a service where there's recurring revenue. You sell a chip once, and then if you want to do more business, you have to sell another chip. So it has had quite a few waves over the years. Obviously, each wave has got bigger. They came up with this technology called CUDA, CUDA, which is effectively allows software engineers to program the graphics chips, which was quite a big thing at the time. And so that's been another evolution. Obviously, we've talked about gaming, and then we briefly touched on crypto. So those were a couple of other big waves for the semiconductors, like NVIDIA. We may have mentioned as well that at the moment they sort of have somewhere between 80 to 90% market share of the data center chip market, which is phenomenal, really. There's only one other competitor, which is AMD, that's estimated around about 10%. Intel's talking about having a go. It's very nascent, so they certainly have the market to themselves, but I suspect that won't be the case forever.
And that's a great segue actually into where I wanted to head next. But fun latent fact was the the company I chose to back in this space was AMD, which has not performed quite so well so far, although still very well actually on the heels of it, of the NVIDIA rise. But unfortunately I could have gone that one, but anyway, it doesn't matter. So it goes sometimes. Hey, so just on that, we've touched a little bit about the profitability of the company, and right through, it's got the pricing power, it's got the scale, it's got these products that's right now being driven by a massively quickly adopted technology. You've just touched on it there, Mike. I'm interested to hear what you think the real competition will be for it, and is there any sort of at its heels already?
Yeah, I think we could probably both chime in on this one, Guy. It's inevitable that competition will arrive in industry particularly when a company's producing gross profit margin of 75%. That will lead competitors to an industry. Think about it as well. If you're a mega cap tech company that's spending $20, $30, $40 billion on these chips, after a while, you're going to go, maybe we can make these ourselves. And so, they want to potentially control that manufacturing themselves. And also that's a lot of money you can invest into this technology yourself rather than outsourcing to a third party. So I still think that they will be at the avant-garde of chip manufacturing for sure, but their market share is unlikely to remain as high as it is, and certainly the gross profit margins will likely come back down. Guy? Yeah,
no, absolutely. And I think probably the biggest threat in the near term is possibly from those other large tech companies, the cloud service providers, Google, Amazon, Meta, for example, Microsoft, developing their own chips. I mean, some of them already have their own products, and they're still buying from NVIDIA, but because NVIDIA has the best products, but that's not necessarily going to be the case forever. And also in the inferencing markets, you don't need such high compute power. So, possibly as that market becomes more of the overall market, as companies, start, using the models in a more detailed way and for specific applications, perhaps you don't have to buy a real high-end NVIDIA chip like you do now. So that's definitely a threat. There could always at any point be some smaller company coming out with just basically a better product. That could happen. It's not that likely at the moment, but that can always happen. And I think we've said it before, things are changing so quickly in this sector. So for example, I was speaking to some experts ahead of doing this podcast, and one of them was saying that a few months ago last year there were some announcements made by Microsoft and Amazon in 1 week, which essentially he thought put about 200 startups out of business in the week, just because Microsoft and Amazon have so much power, they have so much money to spend on R&D. They both made some announcements and developments offering some products for free, and that's those startups were just taken out of the market straight away. So it's very hard for new entrants to come in. But then again, the technology is changing really quickly, so there are opportunities for that to happen. So and just Mike mentioned AMD. AMD's MI300 chip is pretty good. It's probably not as good as NVIDIA's best chip, but they're certainly doing well, and they're likely to take more share as well, especially as they're cheaper. So yeah, I think competition is coming, but probably we don't have to worry too much about it for the next few months.
No, great. We haven't touched too much on China specifically there, with a lot of things, technology, they can be one of the bigger competitor risks. Certainly a lot of investment happening into that place. You've mentioned a lot of the other US and with large tech, but what's your feeling on China specifically?
Yeah, I think as it relates to NVIDIA, so over the last 2 or 3 years, China, in terms of how much revenue they get from China overall for the whole company, has been around 20-25%. So in theory, that's been a bit of a risk because the US government has been imposing restrictions on the sale of Western technology into China because they're trying to prevent the Chinese from producing the most advanced semiconductors themselves and acquiring advanced AI chips. So there's been some issues there. NVIDIA's managed to find ways around that by selling via different countries or and then the Chinese have been buying on the black market and paying high prices. So, and NVIDIA is now developing specific products for the Chinese market that sort of get through the US government restrictions. So yeah, it has been viewed as a potential risk that if there was a real block happened from the US government, that there would be an impact to NVIDIA's revenues. But actually last quarter, the revenues from China, the company disclosed this, was down to mid-single digits, so like 5-6%. So I think it's probably less of a risk right now than it has been in the past. And in terms of, is China going to have competing technology to NVIDIA's high-end chips? I don't think we'll see that for a while, even if the Chinese are making really good progress in technology as a whole. I think they're pretty far behind still on this.
Great. There's lots of really interesting stat or bite-sized sort of facts coming out, my LinkedIn at least, lots of NVIDIA stats, and I saw a graph come through, I can't remember who shared it the other day, but it was like a Intel versus NVIDIA stock price over time and how that's changed, and super interesting over the last sort of 20, 30 years. But one of the ones I'm really interested in, or just another one for people listening, is the question on whether it's overpriced. And the market cap for NVIDIA hit US dollar 1.7 trillion. It wasn't that long ago we had our first $1 trillion company, and now we've got them like sort of just appearing as quickly as this one has. But that's the same as all the Chinese companies listed on the Hong Kong Stock Exchange. So just truly gigantic market caps, and I'm just interested in what for both of you actually on your view on how sustainable that is.
I mean, if I can start on this one, and Mike, you can add in. You're actually slightly out of date, Leighton. There's $2 trillion now after the move.
Oh, well, I can't keep up. I've had to stop looking at it because I missed it.
So what I would point out here is that if you look at the price earnings multiple, which is one way of valuing the company, 4 years ago, that was 30 times, just over 30 times. As of today, the price earnings multiple is still just over 30 times. So even though the shares have had this huge move upwards, it's all been driven by earnings. It's not been a re-rating. So the shares are not actually that expensive. In fact, they've derated in the last year because the earnings have just gone up even faster than the share price. So in some ways, it's not that expensive at the moment.
Yeah, I mean, many are likening the run NVIDIA at the moment to like Cisco in the late 90s and the tech run back then. What I would say is quite different to this time, as Guy has mentioned, is that the earnings multiple of these companies. So you had, at the end of the tech bubble, you saw things at 100 times multiple, or you saw a significant number of IPOs coming in with companies with no revenue at all. I mean, I can't think of any IPOs that have come in the AI space. They're probably coming. And when you get a bigger IPO coming through with a ridiculous valuation, that's possibly the time, we're near the end of that. I mean, you can cite an IPO almost around the top of every significant cycle. We haven't had that one yet. That's not to say that NVIDIA's price is going to continue to go to the moon. I think it's very much driven by earnings. And as I said earlier on, there is a difference between, say, a Microsoft and an NVIDIA at the moment anyway. It's because NVIDIA doesn't have the software as a service. It's not the recurring revenue model. They've got to keep selling quarter after quarter. And that's possibly why the multiple hasn't gone up. And I think there's certainly a lot of skeptics out there to say, hey, at some point, NVIDIA's sales are going to hit a wall. We don't know when that is. The CEO is currently saying they see strong demand through to the end of 2025, and that's possibly the case. But, eventually those sales will, people will have the chips that they need. One thing to think about, though, in terms of AI is that, where are we at in terms of the bubble frenzy? And I think we've definitely got a way to go because to put things in context, if you think how important to society or how relevant was, say, the automobile out of a scale of 100, maybe that was a 20 or 25. The personal computer was possibly around the same. The internet was possibly 50 out of 100, but then you have to get to things like electricity, which were maybe on a scale out of 100 out of 100. And AI is right up there. I'd say it's close to 100 out of 100 in terms of its relevance and its impact that's going to have on society in the decades to come. So, really we are just right at the beginning of this still.
Yeah, really interesting. So many things to unpick there a little bit, and I'm not going to try to do it all now, but sort of people forecasting 2025, we're still actually so early in the adoption of AI. Like, there are companies moving on it, but it's still, I would say, not even close to mass market. People are starting to experience it, people are starting to learn it, and I think there's going to be a lot more. But I guess what is possible is the companies that are going to be manufacturing and using the bulk of this processing power and stuff to generate this are already doing it, and we'll see them grow a lot into the future. Anyway, that probably just brings us, let's talk a bit about AI a little more broadly. There's lots of aspects to AI. The growth is rapid. Where are you two seeing the investment opportunities in this space at the moment?
Yeah, so Leighton, you're right in saying growth is really rapid, as we just talked about, and the pace of change is very rapid as well. So how are we looking at it? So to start with, we are investing in what I'd call the picks and shovels of the AI opportunity. So by this, I mean companies that are helping to build the infrastructure, whether that's the hardware or the software. So these companies are going to sell to enterprises who will actually be building AI apps or using AI in their business to grow their sales. And it's still really early to know which applications will be successful, what will be the killer app. We don't really know that yet. So we think it's a kind of low risk play to own the infrastructure companies to start with. So in our funds, we do own NVIDIA since about 18 months ago. And we own some of the other mega cap tech names, of course. But we also own some semiconductor design automation companies such as Synopsys and data center owners and operators like Equinix. And that's a way of playing the AI theme. So that's kind of how we're looking at it at the moment.
Yeah, nice. One of the fascinating things about they're all very large, well-known companies, right? And playing in the space, and maybe again, as opposed to you were touching on the .com bubble earlier, Mike. At that point, driven by a lot of unknown companies in the value and stuff. But yeah, fascinating. Within the space, there's always risks. What are the risks that you're considering with regards to the investments out of Pi as well at the moment?
Yeah, so we what I think is something that's really important to understand is I think that some of the losers from AI, as in companies that have their business model threatened by AI, we're going to find out about those like really quite quickly. And I think we're going to find out about the losers probably sooner than we find out about some of the winners in terms of the applications, etc. So some companies that will see their business model negatively impacted, and we saw that earlier in the year. There was a US company called Chegg, which provides an online learning platform, and their share price halved in a day because they came out and said students are using ChatGPT to help with their homework and to help with extra study. They don't need us anymore. So you're going to have to be really careful and make sure you're investing in companies that are not threatened by this. That's almost before finding out where the real opportunities are. So I think the risk will come out quite quickly, and so we're really focusing on making sure that we don't own companies where AI in whatever form is going to be a real risk to their model.
Let's just talk a little bit about sectors. We've touched on some already, but those that might be positively or negatively impacted over the next 5 years, because 5 years, the lifetime of AI is going to feel like a bit of a very long time, I imagine. I think we're going to see a lot of evolution, but in the world of investing, that's a very short period. So, which sectors are you sort of considering on the positive and negative side of that at the moment?
I mean, that's a really key question. I think it's pretty early to have any sort of real definitive answers there. I think one thing we know for sure is that AI is going to really improve productivity generally. So that's going to be good news for a lot of companies' earnings. It's also quite disinflationary, so that's good news for central banks who are trying to make sure inflation doesn't carry on going up. So we think improving productivity is going to be pretty key for equity markets as a whole over the next few years. On the negative side, there are some vulnerable areas. So I think that white collar workers who operate in like middle or back office roles, such as maybe accounting or payment processing, some of those jobs are actually going to disappear. AI is going to make that whole process much more efficient. You're not going to need so many people. So there are some threats there. So we want to make sure we're not investing in companies that are really key suppliers to those kind of roles. In education, I mentioned that earlier. I think AI could be quite transformative as well from, hopefully mostly in a good way. But if you're in education, you've got the wrong business model, then you might not have a business model quite quickly. So we're going to look to invest in companies that, as I mentioned, provide the tools for others to use AI, or that are leaders in using AI themselves as a way of staying ahead of the competition or improving their profit margins. So it's pretty hard to be really specific about which sectors are going to be impacted in a good or a bad way. Apart from some of the examples I gave. But really we want to find companies that use AI in an intelligent way to help their future growth.
Mike, over here in New Zealand, we're a little distant from the action. And that being said, there are a few companies popping up, on the exchange as well, who are using AI and creating businesses out of it. But it'd be good to know your perspective on how it's been considered in the wider investment community here, and what you're hearing about it in your circles.
Yeah, I think it's probably not being talked about enough by the New Zealand investment community. We are a long way from the nerve centre where this is happening. And of course, because it's being dominated by mega cap tech, we just heard from Guy that startups who try are being squashed very quickly. So New Zealand, I guess in the past, has been quite good with startup businesses, potentially a couple in the tech space, as we well know, but I'm not sure that this type of technological move will suit our nascent industry. Maybe not. We talked about the fact that, we own NVIDIA and a number of other AI plays in our Pi Global Growth 2 fund. And I'd say that because NVIDIA is now, the third largest company in the world, that most of your listeners with KiwiSaver probably have some form of exposure to it, even if they don't know about it. But it definitely warrants more discussion. Because as we've mentioned, there'll be some industries that will suffer and some that will benefit, and it's quite hard to pinpoint exactly, other than to say that it'll touch everything.
Great. Well, I think we might just wrap up with one final question, which is how you think retail investors should approach AI. There's a lot of information out there. It can be overwhelming. In the same blog post or information source, you can see AI bubble and AI to the moon. And obviously there's a lot of hype around it, somewhat driven by the fact that it's turning into very inflated portfolios for some people who held stocks like NVIDIA earlier. So thoughts on how retail investors should approach AI? Look,
hopefully I don't look too old, but I have seen a couple of cycles go through in my time, witnessed the real estate boom from the 2008. I was investing through the tech bubble as well, so I kind of understand a little bit how this works. And of course, all bubbles start on fundamental grounds, and this one has got a really solid fundamental ground to get going. And I can understand why investors want to get involved, because they should be, and that's why we're involved as investors as well. And it's exciting. New technology is exciting, and it's quite easy to kind of build a castle in the sky as to what this might look like in the future. So investors should want to be involved, and we've mentioned a number of ways that they can do it. It's not just exclusively through NVIDIA. There are other chip manufacturers, other type of infrastructure, data center plays, things like that. So certainly wouldn't want to, put all your eggs or all your chips in one basket. In this case, you want to spread yourself a bit quite wide. And in particular, just be mindful of the fact that, these things don't go forever. And when they do finish quite quickly. In the case of Cisco in 2000, a lot of their business revenue was building up in the late 1990s due to the Y2K factor. People wanting to check all their computers and that everything would work. So when they got through to the March 2020 result and said, hey, we haven't actually got any of that demand here anymore because people have already spent their IT budget. So that kind of was, it's been called, with the benefit of hindsight, as the reason for the bubble bursting. So we may get to a point in, 12, 18 months where the mega cap tech companies say, okay, NVIDIA, we're doing this ourselves, or there's this like peak in their sales. And what we should remember is that doesn't mean that the AI revolution is over. Because if you look at the internet, March 2000, most people are still on dial-up, even if they had the internet. Of course, it just kept on running for decades. And so that's what will happen with AI, is that the market, NVIDIA, may top out 12, 18 months, who knows? But the AI revolution will continue.
Great. Excellent summary there. So thank you so much, both Guy and Mike. Guy for tuning in from London, Mike from the Hawke's Bay, I think today. Is that right?
Hawke's Bay, yep.
All right, great. Really appreciate your insight as always. And as Mike touched on earlier in the episode, I think anyone with KiwiSaver probably has exposure to NVIDIA already, given its place in the S&P 500 and being such a large cap stock in America, and always good to delve into what you're holding in those portfolios as well when you're considering your overall asset base. So thanks so much everyone for tuning in. You can watch Shared Lunch on YouTube or the podcast on Apple, Spotify, or wherever you get your podcasts. Leave us a rating and tell us who you'd like to hear from next. Enjoy the rest of your week.